Welcome to Pete's Property Podcast, brought to you by Buyers and hosted by Pete Wargent, buyer's agent, finance and real estate expert, and all-round property guru, plus published author. Join Pete for 30 minutes as he chats all things property with a new guest each week. Learn practical tips from the movers and shakers in the property industry and well-known personalities sharing their property journeys.
G'day, welcome to this week's episode of the Pete Wargent Property Pod. I'm delighted to welcome back onto the show popular guest, probably our most popular guest, Michael Yardney. Michael, welcome. It's great to have you back.
Thank you very much for having me back. And I'm probably the most popular because I've been on the most often. While I know you've really got some fantastic guests every week, I enjoy listening to your podcast.
Well, we won't mention how long you've been around the traps, but a few cycles, shall we say, to put it politely. So that was actually the reason I wanted to get you back on the show, because all of the talk at the moment in the media is about what's happening from day to day and from week to week. All kinds of talk about whether interest rates are going to go to 3% or 3.5%, and everything's so narrowly focused around the next week or two or the next month or two. And I guess what I wanted to talk about was the history of Australia's property cycles and some of the structural shifts that we're seeing, and what you think will be the main drivers of housing prices going forward in Australia. I guess having had 5 decades or so of property market experience, you would know better than anybody. And I know you've recently pulled together a report on this subject. Do you want to tell us a little bit to begin as an overview of some of the findings?
Sure. Well, I think that we're going to have high interest rates for a while yet. Inflation is going to keep eating away at the average Australian's household's budget, because even though it's going to very likely peak at the end of this year, the Reserve Bank and all the forecasts are suggesting it'll take a while for it to come down into that comfortable level of 2 to 3%. And so therefore, that's in general going to make properties less affordable because serviceability is going to be more difficult. And I don't think property values are going to crash to make them suddenly more cheap. So therefore, I guess the question is, what is going to cause property values to increase moving forward? And I believe in the long term, it's going to be more things like demographics, how many of us there are, how many families there are, how we want to live, where we want to live, and basically the wealth of the nation, those who can afford to pay more. I think that's going to be more important in the long term, Pete, than the short term fluctuations of interest rates, inflation, government intervention, and things like that.
Yeah, and I guess the big one I've always felt for Australia as a land of opportunity, not only very resources rich, but it's really the demographics that's the big one. Yeah. I guess it's so easy comparatively for Australia to attract people to come and live here, including people like myself. You know, you within reason, you could choose to live anywhere in the world these days, and yet Australia is always very close to the top of the tree, if not the best place to be, in my opinion. So demographics is obviously a part of it. When you've done market research before, you've shown a lot about some of the structural shifts that we've seen in Australia over the decades, by which I mean things like the 1970s with the high inflation, and then more two-income households coming into the market. And then from the 90s onwards, we had the deregulation in financial services, then the mining boom, and so on. Tell us a bit about the structural shifts that you've seen in the housing market over the decades, and what do you see going forward?
Well, we know the property market moves in cycles, Pete, so it goes up and down based on a whole lot of short-term factors, a lot of them related to finance, a lot of them related to consumer confidence. But every now and then there is a big boom, a significant boom. What we had recently, in my mind, was a once-in-a-generation boom in 2020-21, when almost every property went up 20 to 30% in value. And we always love those. I don't think another one of those will happen for a while. But I first experienced it when I bought my first property in the early 1970s. And there was high inflation then. And inflation is the friend of those who own assets. And so it helped me then. But at that stage in the 70s, the big structural shift was more women entered the workforce. But more importantly, banks started to accept their income for serviceability. Prior to that, they didn't. So that gave the average household sort of twice as much borrowing capacity. Suddenly got more borrowing capacity in the 70s, it created a property boom, and that was a great way for me to start. Now, I didn't understand all of this. I just thought this is fantastic, and it allowed me to buy a number of properties. The mistake I made was when they went up in value, I sold a couple of them, which, knowing what I know now, I wouldn't have done. And then the market went up and down and had a recession in the 70s and the 80s. The next big structural shift was sort of in the 1990s. It was over 20 years later, Pete, when there was a deregulation of the banks. So the property market still kept going up, but the next time we had a big boom, like the one we've just experienced during the COVID pandemic, was the 1990s when there was deregulation. From memory, I think it was Aussie John Simon's Aussie Home Loans entered the market. Prior to that, you had to borrow from banks or building societies, but all of a sudden, lending criteria were less restrictive. This allowed people to borrow up to 95% loan-to-value ratio. More people could borrow, and this created a significant property boom in the late 90s. And then in the 20s, the early 2000s, I guess I should say, we had a mining boom, and that gave people a lot more wages. And again, if you've got more money and you can borrow more, that created a property boom. In the late 2000s, there was the global financial crisis that created a bit of a downturn, but then Australia became the preferred destination of foreign investors. We had a mining boom that stopped us falling into recession like other countries did. So foreign investors putting money here, as well as us having more money. That was a big structural shift. And the last big one was, as you already hinted, Pete, the one for 2021, when we saw interest rates drop to historic lows, and it gave the average borrower so much more borrowing capacity. But there was also a raft of government stimulus, and that came at a time of significant pent-up demand because we weren't buying as much. We had a number of years of problems getting finance with the Haynes Royal Commission and APRA restricting finance leading up to the 2019 election, and then the property market started to pick up, and then COVID came. So that was a real combination of things, Pete, but that's over, and I don't think we're going to see a structural shift again, a big one like that, for quite some time, Pete.
What about on the demographic side? Because we used to talk about the baby boomer generation being like I think the phrase was like a tennis ball going through a snake, yes, or whatever it was. I mean, in Australia, that's not strictly speaking true because we've got bigger generations coming because of our high immigration program. But nevertheless, there's going to be a fair chunk of, I guess, my parents' generation, the baby boomers. I mean, they will be around for some time to come, but at some point, as the baby boomer generation moves on, there's trillions and trillions of dollars of housing market wealth tied up in the baby boomer generation, and presumably that's going to be distributed to families in some way. Now, Australia doesn't have the big inheritance taxes or death duties that a lot of European or other countries have, so it's going to get passed down. Now, how do you see that impacting the housing market? I'm guessing at first blush that means there's going to be some fragmentation about the markets that do well and those that don't.
I think you're right there. So you were correct in saying the baby boomers for many generations have actually led the property cycle, and the concept of a tennis ball being pushed through a hose was the concept that there were so many more baby boomers. So my generation of baby boomers, they had to build more kindergartens. Our parents bought houses in new estates, so they had to build more houses, more schools, more high schools, more universities to accommodate all the baby boomers. And I guess in due course, it'll be more aged care as well. But we're not retiring as early as our parents did, and we're not going to move into retirement villages. But the statistics suggest that, I guess, in due course, the men will die off first and then the females. We know that there's around $10 trillion worth of real estate. It's dropped to about $9.7 trillion worth of residential real estate in Australia. And there's also all the money in superannuation funds. But if you look at real estate, it's suggested that about 6.2 trillion of that in residential real estate is owned by baby boomers at present. And that makes sense. They bought their homes 20, 30, 40 years ago. They've paid them off. They've bought investment properties. And in due course, when the baby boomer females die, and that won't be till the mid to late 2030s, there's going to be a huge intergenerational transfer of wealth. And that clearly is going to go to the Gen Xers and the millennials, the kids and grandkids of the baby boomers, who already are going to have owned their own home. They're going to be in their 50s and 60s by that stage anyway, Pete, and they're going to suddenly get this huge inheritance. And I don't know what they're going to do with it, but they're probably going to invest in real estate again. And so that could be the next big structural shift. But boy, that's at least 10, 15, maybe even 20 years off, Pete.
Yeah, so again, and also it probably wouldn't all happen at once. It's a gradual redistribution, I suppose. You mentioned just before the property market cycling through the decades. So let's talk a bit about cycles. Now, I know that Stuart Weems from Pro Solution is a good friend of the show. Hi, Stuart. He did some research a while back to show that over the last sort of 4 decades or so, if you look at the sort of average market increase from Melbourne and Sydney and Brisbane, the returns are, I guess they're more similar than different per annum, but what his sort of research showed is that the markets to some degree cycle at different times. And I guess being Queensland based, I've done a bit of market research myself over the years and found that sometimes I think the suburb that you pick can make a bit of a difference to those results, maybe 1 to 3% per annum, which doesn't sound like a lot, but over 40 years, it's a huge amount. But I think more than that, probably the type of property that you choose within the suburb is at least as important, if not more important, in terms of the results you get. So how do you go about thinking about property cycles and the kind of the way in which you can use those to your benefit?
Well, we know that the property market moves in cycles, and while the long-term trend is up, there are always periods of flat growth or falling prices like we're currently experiencing. But if you take the long-term trends, and you're right, Stuart's done some great work, as I know you have with your team, and we have at Metropole, using the same data, the Australian Bureau of Statistics data, only goes back 42 years. But the long-term trend for well-located residential real estate is up. And then interspersed with that, there are periods when the property values fall. But after the property values fall, they don't suddenly go up again, Pete. There are long periods when there's minimal overall growth. But if you go back 42 years, Melbourne's property price growth, the Melbourne capital city, grew 8.2% per annum. Sydney property values increased 7.9%, compounding per annum. Brisbane was a little bit less than that, 7.6% per annum. But overall, well-located properties doubled in value. They've got to grow at 7% per annum to double in value every 10 years. But you've also got to be patient, and you've got to hold on to those properties, because if you bought at the wrong time of the cycle, there could well be a period of 5, 10 years when minimal growth would occur. So you've then got to look at deeper. Capital city values are interesting, but what you've got to do is look at what creates property value growth in the short term as well as the long term. We've already talked about the long term. The property values are going to go up because of demographics and, in my mind, also the wealth of the nation. But maybe we should just have a quick look, Pete, at some of the things that are going to drive property values in the short term.
Yeah, sounds great. So, well, exactly that. What are the reasons that you believe that property values increase over the shorter to medium term?
Well, we know interest rates is a big factor. Obviously, low interest rates made it easier for people to borrow over the last couple of years. Money was cheaper. But interestingly, the converse isn't always true. In the past, property values continued rising for some time despite the Reserve Bank raising interest rates. That hasn't happened this time for a combination of reasons, Pete. Firstly, because we had a huge boom where the value of almost every property went up 20% and the lot went up 30 and 40%. That was unsustainable. So interest rates are one of the factors involved. But more than that, Pete, you write about it a lot. It's actually the access to credit. It's not just how much money costs, but the flow of money. And we know a while ago, APRA tightened the screws and made it more expensive for investors to borrow property. And we know in 2016-17, when they tightened the screws, the property values dropped a bit. And currently, I know you've been writing in your blogs about the challenge with APRA's serviceability buffers, that at the moment they're still saying when you take a new loan, you actually have to be able to service the interest at 3% higher than the prevailing, these new high rates. And that doesn't make a lot of sense at the current climate, does it, Pete?
Well, no, I think it made sense when the cash rate target was next to zero. But I think now we've seen the bulk of the interest rate hikes for this cycle, it doesn't really make sense to still have the extraordinary lending assessment buffer in place. So hopefully that's something that we'll get taken a look at over the next few weeks.
That would be great, wouldn't it? Because it affects people currently wanting to get into the market. So buyers, home buyers and investors are going to have to show the banks they can actually service the loan at the current interest rates plus 3%, and nobody thinks interest rates are going to go up that much higher. But it also affects people coming out of fixed rate mortgage loans, which in Australia are often for 2 or 3 years, while overseas, we know in America, interest rate home loans are often fixed for 30, 40 years or 25 years. So it's very different. So the rising interest rates affect us more in Australia than they do overseas. So money is one of the factors that affects property values in the short term. The other is supply and demand. Generally, if demand outweighs supply, property values rise. If it is the other way around, like we have a building boom, then like we had when we built too many apartments, prices tend to fall. But currently, Pete, there's really a shortfall of properties everywhere you look, isn't there?
Yes. I mean, I was just looking only yesterday, the date of recording, the Domain put out the October rental vacancy rate figures, the lowest on record. And, even now people are talking about restricting lending to investors. So not many lessons seem to have been learned. But this is coming at a time when immigration, having been effectively paused for 2 years, is coming roaring back. And the federal budget showed that for year after year into the future, we're now expecting record high immigration. We've got the natural growth of the population anyway. So the supply is really going to struggle in the current environment to keep up with that demand for new housing.
Sure. So as we talk about that, then really we're talking about supply and demand being one of the drivers of property values in the medium term. Having said that, we know that the government in its most recent budget says we're going to supply 1 million new homes in the next 5 years. Oh, actually, it's not the next 5 years. We're going to start in 2 years' time. Don't know why. And we're going to supply 1 million affordable homes. The fact is that we've been building about 180,000 homes a year anyway, so it's not more than was happening before. And how are they going to supply affordable homes? They're saying they're going to get institutions involved, banks involved, super funds. They're not going to accept the measly returns most mum and dad investors are prepared to accept. So the government's going to have to put its hand in its pocket. So I can see the supply and demand factors being one of the things that's going to underpin our property values in the medium term and, in fact, push up property values, Pete.
Do you want to save on buyer's agent fees? You could save thousands with Buyers Buyers. As Australia's most extensive network of buyer's agents, we can lock in highly competitive prices. Plus, our national network of buyer's agents are some of the best in the business. So get the Buyers Buyers advantage and talk to us today. Call 1-800-975-051 or visit buyersbuyers.com.au.
I was just looking at the FY22 figures, so the financial year just finished. In broad numbers, we built about 175,000 dwellings, but I guess what often gets overlooked is that we demolished 25,000. More than that, it's more about the distribution. So the home builder package helped people to build houses all around the country. But I think increasingly we're seeing stories about, people have built housing estates right out on the city fringe where there's no infrastructure, no transport connections. It's taking people 30 minutes just to get out of their, out of their estate even sometimes. And we may be able to build 1 million homes over the 5 years to 2029. But I think two things. Firstly, that's the bare minimum that we need. We were building that amount anyway, pre-pandemic. But secondly, can they be built in the right place? That's another challenge entirely. And actually delivering the housing stock that the market needs, that's going to be an enormous challenge over the next decade.
So as we're walking through the factors that are going to affect property values in the short term, supply and demand is one of them. The general economic climate is clearly related as well. Government incentives, like we talked about, investor appetite. But I think the big one is actually consumer confidence, because we know that fear and greed normal human emotions are what drives property cycles. We feel most confident when the market's doing well, when all the news is good, and so it pushes up property values. And currently consumer confidence is at very, very lows just because of all the negative media. And yeah, there are problems out there, but there's more good stuff out there than problems. So it's a combination of all these factors that drive property values in the short to medium term. It's a combination of how many of us there are, how we feel, how much money we've got, and how many properties are around for the people who want them, Pete.
I think that will never change. I've often tried with my clients, and as you know, I think often people are just sitting on the sidelines waiting for all of the green lights to line up and some kind of validation that everything's going to be perfect. But by the time that is the case, of course, they've missed the opportunity to buy a bargain, and you're back in the market with 50 other people at the open home and 10 people at the auction bidding. If anything, with sort of day-to-day media, those consumer confidence cycles, particularly as they relate to the housing market, have become more emphasized. And I don't think that will ever change the human element of what drives the market cycle.
No, that's true. So I guess consumer confidence almost embodies all those other things, where we think the economy is going, what the government's doing, what we think is going to happen to our jobs, supply and demand. So it's normal, and we don't act very rationally when it comes to money, do we, Pete?
No, and I think we've even covered on a previous podcast the range of biases that impact people as it relates to money, finance, investing. And I think in the housing market, particularly, people are always looking for some kind of social proof that they're doing the right thing. The problem with that is that it's actually harder to buy when everybody else is buying, and it's much easier in a market like today when there's a lot of caution, a lot of people sitting on the sidelines. But of course, this is what drives the market cycle.
Clearly it does. So I see a window of opportunity now, because I believe probably later this year, at the very worst in the first quarter of next year, inflation is going to peak. I believe early next year, interest rates are going to peak. Whether there's one or two more interest rate rises, even the worst, most pessimistic bank economists think there could only be three. People are going to eventually realise, hey, that's it. That's how high inflation is going. Look, this is how high interest rates are going to go. But I know we're currently sensing that people are just taking that into account, and already many are starting just to move on. I think you wrote a great blog on it just recently, Pete, where you said peak fear has actually already, we're passed through this period of peak fear.
Yeah, we saw an initial drop in housing prices as the market turned. And as you know, when the froth gets blown off at the top of the cycle, you do see prices drop in some cases 10-15%. But yeah, if you look at the sort of the most up-to-date market data, the pace of declines is clearly eased. Depending on which index you look at, eased quite a lot. So it's like a coiled spring or an elastic band at the moment. Just the market's waiting to rebound. But I think a lot of people are just waiting for some kind of indication that interest rates are near the peak. Yeah. And then once they've got that validation, they'll be piling back in, as they always do.
Well, one of the leading indicators we look at is asking prices. So auction clearance rates are a pretty good in-time indicator of what's happening in the market. And we know that auction clearance rates in the two big capitals, which are the ones that are important because of the volume of auctions, Melbourne and Sydney, they've been picking up over the last couple of months. So 6 or 7 out of 10 buyers and sellers are actually agreeing at the price on the day of the auction. But more importantly, asking prices. Dr. Andrew Wilson's My Housing Market asking prices for October remained flat. In other words, they didn't fall anymore. And so did Louis Christopher's SQM research. They were even a little bit more bullish on asking prices. And looking back in the past, asking prices, which is what vendors feel confident in, that's not what they eventually get, but they give a good indication of what's going to happen 2 or 3 months down the track. And so the market is looking for a floor. I'm sure we're going to still see falling sale prices, median prices over the next couple of months, but this the rate of fall is getting less, and there's good indication that, hey, we're getting near the bottom. It's disappointing to see, because if people are getting finance, we know they're going to want to buy. That's dropped a bit, hasn't it?
Yeah, I think one of the things is that the numbers were coming off extraordinary highs through the pandemic. I think pre-pandemic, we were seeing 15 or 20 billion dollars a month being written, excluding all the refinancing, and that went up to 33. So yes, it's dropped back to 25 a month, but it's still probably got a way to fall from there. I guess the thing is there's not so many people putting their homes on the market now, so it is coming back into balance because actually in some places there's a shortage of available stock.
So all that brings us back to the question you first asked me. We never got to answer it. What's ahead for property values? And I think that the recent property boom was very unusual. All types of properties in almost every location around the country increased in value. But I think moving forward, Pete, property markets are going to be much more fragmented, which is basically what they usually are. If you think about it, certain demographic segments will find the rising cost of living due to inflation, due to higher rent or their higher mortgage costs at a time when their wages aren't keeping up with inflation. It's either going to stop them getting into the market or severely restrict their borrowing capacity. So I think this is actually going to more negatively impact the lower end of the property markets, where, in fact, there's already many first home buyers who borrowed to their full capacity a year or two ago, and they're going to have difficulty keeping up with their mortgages because interest rates are rising, they're moving out of their fixed rate loans, their wages aren't going up. So I think in those suburbs, in those locations, there's actually going to be very little impetus for capital growth at the lower end of the market. On the other hand, in the more established money suburbs, the gentrifying suburbs, those locations, people have got high disposable incomes, they've got multiple streams of income, and they're likely to be able to afford to and prepared to pay a premium, because I think location, neighbourhood is going to be very important where people want to live. Post-COVID, they've understood the importance of neighbourhood. And just a few minutes ago, you talked about in the new estates, it's going to take them 30 minutes even just to get out of the estate. So that concept that we've spoken about, a 20-minute neighbourhood, is actually, with the roads going to get busier and busier with all the new people coming to Australia, the 20-minute neighbourhood is going to shrink. You can't get very far in 20 minutes, Pete.
No, I mean, even I went down to Brisbane from Noosa the other day for the cricket. I was actually stuck in a traffic jam at midnight, believe it or not. Now, Of course, they do a lot of the roadworks in the evening and so on, but the traffic is not getting better. And Brisbane's obviously only the third biggest capital city, and Sydney and Melbourne are much larger, more mature cities. So, I mean, you've mentioned, to recap on some of what we've covered, the big drivers, the big long-term drivers for housing prices is going to be the demographics, the future population growth, which we know is going to be huge. We think probably maybe an extra 3 million people by the end of 2030. It's huge numbers for Australia, and also the wealth of the nation that you mentioned. But you think moving forward, it's picking the right neighbourhoods in a more fragmented market. That'll be more important than ever. So how do you go about doing the research to find those kind of locations? Is it art or science, or where do you start when you're looking for the right neighbourhood?
Well, it's really interesting because just before we got on this chat to have this conversation, I was talking with Kate Forbes, who gave me a list of 600 suburbs. Our research department loves doing that, all that sort of stuff. And we looked at past capital growth, we looked at wages increase, we looked at the percentage of owner-occupiers, we looked at what's changed in the census from one census period to the next, and also it included future suggested population growth. So a lot of people say, hey, population growth, let's invest in those outer suburbs which are growing so fast. No, they're growing physically, Pete, but that actually doesn't mean that you actually are getting higher property values. Even median prices often change in those areas, but median prices are very misleading. So when we looked at that, and we've got all this spreadsheet of all the suburbs' median prices, in some suburbs, median prices are very relevant, but the research a lot of people do with median prices is wrong, because if you've got a bayside suburb like I live in, those streets near the water are actually very different to the ones on the other side of the main road, and very different to other suburbs, cities, houses inland. So the same postcode where you've got a diversity of properties, median prices are not as valuable. But we look at median prices, we look at what's happened in the past because it gives us a reasonable indication, but then we actually have a look at what's likely to happen in the future. And one of the big drivers, as we've done research, has been gentrification. That happened in the inner suburbs 2 decades ago. Over the last decade, it's really been more in the middle ring suburbs where old houses are being pulled down. Take Brisbane, your home state, for example. The Queenslanders are being pulled down and people are building 2 homes. In Melbourne, where I live, there are a lot of people, and we're doing it and I'm doing it, pull them down and build townhouses. So you want to see what sort of accommodation is going to be in continuous strong in the demand in the future from owner-occupiers and investors, and then look at where jobs are going to be created. So rather than looking in the rear vision mirror, looking forward, seeing where there's going to be economic growth, jobs growth, wages growth, and also that's going to lead in general then to people wanting to live there and pay more, Pete.
Yes, that does make a lot of sense. I think it's clear just from listening to you there that you take effectively, it's like a top-down approach. You're talking first and foremost about the macro economic environment, then you bring it down to the state and the city level, and then really drilling down to the suburb and the right neighbourhood and even the right parts of the suburb.
Pete, in some streets in Sydney, you'll have magnificent views of the Sydney water, the harbour and the bridge, and on the other side of the street you'll have magnificent views of the houses that have got views of the Sydney water and the harbour and the bridge. So you've got to get down to that level as well. So yes, it is part science and part art.
Anyone in Brisbane would be familiar with the whole range of suburbs as you head out to the southwest of the city, and you've got the high side and the low side, very different dynamics, and also flood risk in some parts of some suburbs and so on. So just looking at a postcode only tells part of the story. So I guess in terms of, you've given some great insights there into how you identify the right neighbourhoods. To wrap up with, one of the tools that you use that I've always found to be very insightful and useful is the 6-stranded strategic approach, i.e. the mechanisms you use to ensure that you get a better result than the average. Because, I mean, look, anyone can get an average result investing in property, but a lot of people get pretty underwhelming outcomes from that. How do you go about using the 6-stranded approach, and what steps do you follow to make sure you get the results you want?
Well, to start with, then, as you said, it starts with a top-down approach to choose areas that are going to outperform moving forwards, and then to find the right property. I only buy properties which would in general appeal to owner-occupiers. Not that we're planning to sell the properties, but because we want owner-occupiers to buy similar properties, pushing up local values. I think that's even more important than ever in the current market. And so I'm also looking for affluent tenants, because your future income is really going to be dependent upon your tenant's ability to pay you not just rent, but increasing rent over time. So we look for those sort of properties. And then I don't like overpaying. Even in today's market, despite what's happening and property values falling a bit, I want to make sure I buy below what I call intrinsic value. That's why we avoid new and off-the-plan properties, which come at a premium price. Look, I like a high land-to-asset ratio because we know it's the land component. That's the 3rd strand of the strategic approach. We know it's the land component that increases, but that doesn't necessarily mean a large plot of land. I'd rather own a small plot of land in an inner suburb of our capital cities than in the outer suburbs where you can buy whole acreages, but they're not worth as much. And it can even be in Sydney in particular, in the right locations in Melbourne, the land under an apartment. The old blocks of apartments we used to call flats, where I'd rather own 1/10 of a block of land in Bondi rather than hectares in Darwin or Alice Springs. We also like areas that are going through demographic change, gentrifying areas like we've spoken about. Just interestingly, I was looking at one of the townhouses we bought for a client in Brisbane a couple of days ago. I saw the floor plan, and it's got 3 bedrooms, but in fact 3 toilets, 2 bathrooms. So a family could live there rather than just 1 bathroom. So something a bit different, something a bit special. A double garage, for example, is something with a twist. And because over the next little while, I don't think we're going to have strong overall capital growth. Apart from choosing the right locations, I like manufacturing capital growth through refurbishment, renovations, development. Now, that's not for everybody, but rather than waiting for the market to do the heavy lifting, I would prefer to do the heavy lifting by adding value, Pete.
Yeah, that does make sense. And if you I think it's with this kind of 6-stranded approach, it's not any one of those individual steps that's powerful. It's the bringing them all together So it's systematic, I guess, and proven over a very long period of time, over 40 years, in fact, by the statistics there.
But more than that, if one fails, it doesn't work, because they're not all going to work for a period of time. You've got others supporting you and underpinning you. So you just don't look for one factor on its own, Pete.
Yeah, that makes perfect sense. And I think all of the great investors would have a set of rules that they follow, and having that kind of framework or template, six-stranded approach makes perfect sense to the logical side of my brain. So that's a fantastic insight into what you think will happen to the housing market in the short, medium, and long term, and the approaches you can use as an investor in those markets. If people want to find out a bit more about what you guys do, where should they go to for more?
Well, like you, I have a podcast, and so therefore wherever people are listening to this podcast, just look for the Michael Yardney podcast, look up for Michael Yardney on social media, or go to Property Update, where every day I have a newsletter that comes out with 8 articles from a whole range of property experts. Just look up Michael Yardney and you'll find me on Google.
Not a difficult man to find online. So, Michael, thanks so much. It's always great to get your insights, and look forward to, hopefully catching you in the Bayside suburb again sometime soon.
Looking forward to it. Thank you, Pete.
Thanks for listening to Pete's Property Podcast, powered by Buyers. Don't forget to subscribe and join us next time as Pete chats all things property with a new guest. And just a reminder that the information provided in this podcast is general advice only and doesn't take into account your personal financial situation or needs. You should always consult a licensed professional to discuss your individual personal circumstances.